The Reserve Bank Governor, Philip Lowe, is warning that it's unclear how high interest rates will go. He got it wrong in the past, saying interest rates weren't going to rise until 2024. So today, we're going to break down everything you need to know about Philip Lowe's recent media release and what he's saying is going to happen, as well as what you can do if you have a mortgage or thinking of getting in the market in 2022. So Jaden, let's break down what Philip Lowe said and what it all looks like.
Yeah, so let's quickly cover off, I guess, the top, most important points that he covered off. Firstly, he said that inflation, it's currently about 5%, will peak at 7% potentially later in the year. And that's really the Reserve Bank's main focus at the moment, is trying to get that inflation down, because you start to notice at the moment, the cost of electricity is going up. There's even talk of shortages. Cost of petrol's obviously more expensive than it's been in recent years. Car prices, food, everything's kind of going up. So the Reserve Bank, in a way to sort of keep the prices from sort of spiraling out of control and getting really expensive, and potentially trying to put the cash rate up to sort of slow down consumer spending. They also said that obviously supply chain issues that were happening during COVID are kind of getting back to normal. So he specifically talked about sort of chip manufacturers and saying, with cars not being able to be manufactured or produced because they didn't have sort of the microchips and the processes they needed, that's sort of sorting itself out. To your point, Nathan, he did also say that he's expecting it, it's reasonable that the cash rate could reach 2.5%. In line with their inflation target at the moment. But, to your point earlier, he was saying less than sort of 2 years ago that the cash rate was going to stay on hold at 0.1% for 4 years. So it's a hard one on that because, there was kind of talk of, depends what happens, I guess, in the wider market. And even he did say in there, like Lee Sales, the interviewer, asked, well, what happens if property prices come off? Like, how's that going to impact the market and what's going to happen there? And he talked about a pretty interesting thing called the wealth effect. And he said, while it's not the Reserve Bank's mandate to sort of worry about property prices directly, it is important for them to monitor consumer spending. And he said the two are really tightly correlated, though. If people, if house prices are going down, it's the opposite of the wealth effect, where your rising personal wealth actually influences your consumer spending. So if your house price is going down, you can have less confidence, you're going to be borrowing less, you're going to be doing less stuff and spending less money and investing less, which slows down the economy, which is ultimately what they don't want to do. So he was kind of saying, if it gets to a point, or if you read between the lines, if it gets to a point where they completely shock the economy and pump up the cash rate too quickly, too soon, they're potentially going to have to cut it. Which, Nathan, I know you had an article on that as well, where a couple of bankers have actually said, this guy's just kind of saying this to kind of spook the market and get that inflation down as quick as he can to kind of right things. So what are some of the big banks and commentators saying, about that?
Yeah, look, I think it's interesting because, as we said before, the Reserve Bank governor predicted rates weren't going to rise until 2024. Now what we're seeing is him having to increase rates earlier, mid this year, a little bit earlier in the year, and really taking a backwards course on what he said. The interesting thing was the banks were actually the ones calling out the Reserve Bank governor back then, saying that, no, we can't see rates not moving until 2024. They all had their forecast for 2022. So it's interesting. Again, we're seeing the banks, which is CBA, saying that Australia's really they're the biggest lender in Australia, saying that the aggressive monetary policy that the Reserve Bank's implementing will need to reverse course and potentially see rates cutting in the second half of 2023. So this is coming from Commonwealth Bank, who are actually forecasting for GDP growth to expand to about that 3.5% later this year, which will be down from 4.7%. And what they're sort of saying is, no sooner will rates go up, will there need to be an aggressive strategy to bring them back down. So that's coming from Australia's largest bank, CBA, who actually are predicting that in the second half of 2023, they're forecasting a potential for 0.5% or 50 basis points decrease. And they are pretty similar in terms of the Reserve Bank governor's forecast, where they're predicting the cash rate needs to hit that 2.1% by the end of this year. And then potentially with a risk of it going to 2.35%. Now, if we're looking at the cash rate at the moment, we've seen two rate rises, one in May, another one in June. The official cash rate is 0.85. So as we can see, we're probably in for a bit of a bumpy ride for rates to get, or that official cash rate to get to 2.1% by the end of this year, potentially by next year at 2.35%, where the Reserve Bank is saying by mid next year, rates are likely to kind of come back down. So, Jaden, what does that mean for mortgage holders out there? And what are you sort of seeing as well?
Yeah, so I guess the interesting thing, there were a lot of positive notes in his speech because he did say, during COVID 2020, it was looking like, there were going to be tens of thousands of deaths. There was going to be mass unemployment, and they obviously did. They called like the Reserve Bank's cash setting kind of like an insurance policy that stopped the sort of government and the economy broadly going, into recession. Now definitely they're sort of focusing on what's going to happen forward. I guess there is, and the other positive he said is like there's over $250 billion in savings now, and unemployment's obviously at low, all-time lows. But like, what does that kind of mean for you if you've got a mortgage, or if you're thinking about getting in the market, or if you're just kind of generally concerned? Nathan, like, what are some of the tips I guess you're sort of giving people at this point, that are concerned about that?
Definitely. Look, I think if you have a mortgage at the moment, there's a few things you can do. One is to review what you currently have. So let's say you've got an existing mortgage, you're paying 3% to 3.5%. Well, right now at the moment, in terms of the marketplace, you can get rates in the low twos. Now, rates are going to go up again later this week. So all in turn, you can usually get about a 1% decrease if you're currently in the 3s and 3.5% in terms of what new lenders will offer you. What that actually means is with that lower rate, by refinancing, you get refinance rebates. And on top of that, that insulates you with the rate rises that are yet to come through. The secondary thing you can think about is fixing in your loan. So as we saw there, the official cash rate is set to increase to that 2.1%. What that means is your variable rates are going to hover around that 4% mark. So fixing in will give you that stability. You'll know exactly what you're up for. Do keep in mind the fixed rates are a little bit higher than the variable rates at the moment. So you have to do some forecasting and try and understand if it makes sense for you, particularly if the CBA's estimates are correct in that rates will come up, but then potentially back down no sooner than they come back up. The other thing also you can start to look at is your repayments calculator and doing a bit of a mortgage on training wheels if you don't already have a mortgage. So for example, if you're looking to get in the marketplace and your mortgage might be $400,000, then doing some numbers based on rates as of today. So let's say you can get an interest rate at 2.5%, looking at your monthly repayments of $1,500, but not only looking at that, looking at where the potential forecast is heading. So if rates are going to be at 4%, sort of understanding, well, on a $400,000 mortgage, my repayments would be about $1,900 a month. At 5%, $2,100, and just making sure you've got affordability to meet that commitment, both in the short term and in the long term.
Yeah, so I think there's a couple of practical tips there. It does feel like it's kind of frightening when things are changing. But I guess, be assured that if you've got sort of savings buffer there, if you've got a secure job, there's kind of going to be increases, but if you've got that sort of buffer there, you'll be able to sort of weather the storm. And potentially, like Nathan said, and even what some of the other economists are forecasting is that this could all be pretty short term. That it might be like a bit of a short term pain, and then sort of start dropping rates again next year as the economy starts to normalize. So, Nathan, if people need any help, how do they sort of find us?
Yeah, look, we're talking to a lot of clients at the moment, particularly if you've had an existing mortgage and you've had it for the last couple of years. Reviewing it really makes a lot of sense. So hit us up at Hunter Galloway. We help home buyers right across Australia, including people looking to refinance. So we're based in Brisbane. If you're living in Sydney, New South Wales, if you're in Victoria, Queensland, wherever you might be, we can help. We help clients Australia-wide. So call us on 1300 088 065. We can give you an absolutely free assessment to let you know where you stand, what can be done. If you don't own a home at the moment, we can look at your assessment, see what you can achieve, borrowing power, all that sort of stuff. Or visit us at huntergalloway.com.au. We're the home for home buyers right across Australia. And we'll see you next time.